Okay, hi everyone. This is going to be the video on chapter 8, right? We're looking at inventory here. So inventory really is what you sell, right? And in this framework, right, we're going to see a lot of cost of goods sold, right? That's an expense. So what's going on here at a general sort of high level framework, when you buy inventory, you don't take the expense. Instead, you wait until you sell it, right? Then when you sell it, you take the expense as the cost of goods sold and you get it off your books, right? So it's like you tee it up. When you sell it, you get rid of it. In this way, right, we kind of have two different business types, right? We have a merchandiser and we have a manufacturer, right? A merchandiser would be something like Walmart, right? So when you go into Walmart and you buy a t-shirt, right? Walmart didn't make that t-shirt, right? They bought it from maybe a t-shirt company, right? And then they resell it to you as the customer, right? So that's the idea of a merchandiser. And whenever they buy it, right, we will see, right, the cost of that inventory, depending on the system you use, right, when you do the journal entry and when you hit inventory, we'll see perpetual versus periodic. But generally, it's going to be basically all of those costs up until the point in time where we have it on our our store shelves, right? It's like arrived, the shipping, right? All of those other things. So we'll see that. In distinction to a merchandiser, you also could have a manufacturer, right? So say that we have a pizza company, right? They sell frozen pizzas. So the stuff they sell, they actually make. They don't just like buy it from somebody else, right? They actually make those frozen pizzas. So they're going to have their inventory account broken out. Specifically, right, they'll have an inventory for raw materials, which will be like the dough, right, the flour, all those kind of fundamental things, right? They'll have WIP for sort of after we have the raw materials and we start mixing them together, right? We'll have sort of like a product that's halfway there, and then we'll have our finished goods, right? Once that pizza is like all the way cooked, put in the box, we're ready to ship that out, right? So you would see those on the balance sheet there for a manufacturer. And whenever you take managerial and cost accounting, you'll see the journal entries for that. Essentially, you sort of transfer it over from the raw materials, right, and those sort of secondary costs into your WIP. Then you take it from your WIP into your finished goods. When you sell it, that's when you hit the cost of goods sold. But you'll learn more about that in your cost and managerial accounting class. So returning to sort of traditional financial accounting with inventory, right, we have a perpetual versus a periodic system, right? Perpetual is kind of like a live system in the sense that anytime we buy, sell, return inventory, we will make a journal entry for it, right? So we will do cost of goods sold, right? Potentially in the middle of the period if we make a sale. And this is good, right? Because it helps us, because we're doing everything live time, right? We know where we're at with our inventory, right? If we can at any given point pull up the system, right? So here's an example, right? Under a perpetual inventory, whenever you buy it, debit inventory, credit payable, assuming it's a payable. Whenever you sell the inventory, right? I don't know, maybe it's right here, we made that sale. It's going to be two journal entries, right? One to record the revenue and one to get the inventory off the books and record the cost of goods sold there. Right, so you can see whenever we do perpetual, a lot of times we're just straight up using the inventory account. So this just says, hey, a lot of businesses use perpetual. If you think about it, right, if there's any store you go to, right, when you check out, there's like barcodes. Even if they use a perpetual inventory system, they will still do a physical count periodically. The reason for that is a perpetual inventory system, right, the computer system, that doesn't know if anybody stole the goods, right? So you'd have to go out and like physically do a count to see if anybody, stole stuff or there was spoilage or maybe an employee, lost or broke some of the inventory. Now, in distinction to a perpetual inventory system, right, we're going to have a periodic inventory system. And the idea with this is, at least for cost of goods sold, right, we wait until the end of the period to figure that out, right? We're going to back into it through a physical count on there, right? So, and the thing here when we're talking about inventory, right, if you think about that T account, right, it's going to be your beginning inventory plus any purchases minus what you sold gives you your ending inventory, right? If you were to rearrange that T account, right, you just wanted to solve for cost of goods sold, we have an equation there for it. The other thing to be aware of with the periodic inventory system is, to the extent, right, we have journal entries throughout, we're not going to hit inventory, right? We're going to hit a lot of these temporary accounts. And then at the end of the period, we can get rid of those temporary accounts. All right, so here's an example. You can read through those facts, but again, this is a periodic inventory system. So hey, we made and we bought some inventory, right? We're not going to do debit inventory. We're going to have this temporary account, right? So I'm going to put a T there. We make a sale during the period. That's great. We record journal entry 1, right, the revenue, but we will not record the cost of goods sold here in the middle of the period. We're going to have to wait until the end of the period. And here we are at the end of the period, right? What we'll do is, oh, hey, we had that purchases. We got to get rid of that. That was a temporary account. Hey, we knew our beginning inventory. We'll get that off the books there. We know our cost of goods sold, right? So then we can hit our ending inventory for where it needs to be, right? So 540, 180, how did we get those numbers? Right, well, we started with 120, we bought 600, right? That's going to give us our goods available for sale of 720. Our ending inventory, right? We go do a physical inventory count there of 180. Well, that must mean that our cost of goods sold is 540, okay? And another way of showing you that here, so what did we do during the period? We recorded those transactions. Here we are at the end. We got to get the temporary accounts off the books. We got to get our beginning inventory off the books. We go and send somebody out to the floor. They do a physical count. That tells us our ending inventory. We can plug our cost of goods sold there. Right, so there's good and bad with each of these systems. Right, the perpetual, what's the good, what's the bad? Well, the good is, right, at any given time, we can know what our inventory levels are. The bad is it's expensive to do this, right? You got to have the technology. What's the good and the bad with the periodic? Well, the good is it's not as expensive, right? But the bad is we really don't know our inventory levels until the end of the period. So we're kind of in the dark there on things. All right, next, let's talk a little bit about physical units included in inventory, right? Whenever we buy inventory, what goes in that account, right? So the first thing becomes goods in transit, right? So imagine that and you got to remember, we're looking from the buyer's point of view. We're not the seller here, we're buying inventory in a lot of these situations. So say you have Walmart, right? And they buy the t-shirt from the t-shirt company, right? And the t-shirt is sort of, in the mail right now. It's like halfway between them. The question becomes, is that Walmart's inventory or is that the t-shirt company's inventory? Well, to help resolve this, essentially, right, you would look at the contract terms, right? They have a contract for the sale of that t-shirt, which would specify essentially when legal title passes, right? And in that framework, you really have two different shipping terms, right? The first one is this FOB shipping point, which says, hey, as soon as t-shirt company, puts that in the mailbox or gives it to the post office, right? They ship it. That is now Walmart's inventory. On the flip side, right, you have FOB destination, which says, hey, t-shirt company, right? This is your inventory. unless and until it reaches Walmart, right? In other words, from Walmart's point of view, unless and until you get it, it's the other guys, right? So if we had a situation here, right, where the T-shirt was, in the middle of being delivered, and someone came up to you and said, "Hey, you're the accountant at Walmart. Do we include this T-shirt in our inventory or not?" Well, you would say to them, "Well, we'd have to look at the shipping terms. If it was FOB shipping point, it's our Walmart's inventory. If it's FOB destination, it's still T-shirt company's inventory because it hasn't got here yet. It hasn't reached the destination." All right, how about goods on consignment, right? Well, we've seen this before with sales revenue, right? The question here becomes if you're a consignor or you're the consignee, right? Whose inventory is this? So imagine that you were a music store, right? And you sold guitars, right? You then go to, let's just say, the pawn shop, right? We'll just say Pawn Stars, right? And you give it to Rick, right, from the show. And you say, "Hey, Rick, I'm going to give you this guitar. Can you please sell this for me? And I'll give you 10% of the sales price," right? In this situation, you're the consignor and they're the consignee, right? So if I came up to you afterwards and I said, "Is that guitar part of your inventory?" Uh, you could make arguments both ways. So Gap comes in here and basically says this, right? Unless and until Rick, the consignee, sells that inventory, it is still yours, music store, your inventory. In other words, there's a difference here between physical possession and legal title, right? Rick has physical possession, but you retain legal title. So unless and until he sells it to a customer, right, that's still your inventory. It's still got to be on your books. All right, how about sales returns, right? So we talked about when you make a sale, there's two journal entries, right? For the revenue, for the cost of goods sold. Whenever somebody returns that, right, for purposes of this, right, and we've seen the revenue part in the other chapter, but for inventory and cost of goods sold, right, you got to reverse that out, right? If you did X over here, you got to undo that X, right? So you would then debit inventory and credit cost of goods sold to essentially undo that journal entry whenever you sold it. All right, so we talked about that inventory equation, right, where it's like your beginning plus your purchases minus your ending gets you your cost of goods sold. When we talk about purchases, they really use net purchases, right? So that's going to be your total purchases plus kind of those other costs to get it up until the point in time, hey, it's in your store. And then we're going to back out any returns and discounts on that. Right, so let's talk about some of those costs associated with it that you would capitalize and make part of inventory, right? So freight in here, this is just a way of saying shipping, right? Whenever you buy inventory, right, you may have to pay shipping for it. Well, that shipping is going to become part of the inventory account on there. And if you're using the perpetual system, right, that's great. You can just hit inventory for it. But if you're using a periodic system, right, you're going to use that freight in, which is a temporary account, right? We're going to see a lot of this framework temporary, in periodic, and then get rid of it at the end of the period. On the flip side, right, if you sell inventory and you pay shipping, it's just probably going to be a shipping expense, right? You're not going to capitalize that as part of the inventory. How about purchase returns, right? So you bought some inventory, right? You're not the seller here, you're the buyer, and then you return it. Well, if it's a perpetual inventory system, right, you'll just get the inventory off the books. That's great. You can credit inventory. But if it's periodic, right, you're going to hit this temporary account for the purchase returns. Okay, and we'll see this, in sort of a bigger example here. How about purchase discounts, right? So we talked about total purchases. We talked about those other costs to get it to the store. How about discounts and returns, right? We talked about returns. What about discounts? Well, we've seen this before, right? The classic 210 net 30, right? So again, we're looking from the buyer's point of view. We're buying inventory. We also have here, as we've seen before, a gross way of accounting for this and a net way of accounting for this. And this really comes down to, do we believe we're going to take them up on this discount and pay within the window, right? So in this case, right, looks like we bought some inventory for 20 grand, right? That's great. If we use the gross method, we're going to hit the inventory here for the entire amount, the entire 20,000. If it's the net method, right, we're going to hit the inventory for essentially what we think we're going to pay after the discount. In other words, we assume in the net method that we're going to take them up on that discount and that everything's going to be good, right? So let's say that's the facts, right? There was 20,000, right, that we owe them. We bought some inventory. Here we are within the window, right, within that window where you get the discount. And we're going to say, hey, of that 20, right, we're going to try to pay off 14, right? How do you account for this under the gross and net, right? Well, in the gross method, right, whenever you teed up, that original amount, it was for the full amount, right? So now, right, you're going to have to account for the discount, right? Because it's within the window, right? We got to get that inventory off the books for the discounted purchase, at least, 2% of the 14,000 there. The net method, right? You're good to go, right? You accounted for this up front, right? I'm already taking the discount. Hey, I'm within the window. That's great, right? So it's kind of like frowny over here, right? You got to do a little bit of work. Smiley down here, we've already accounted for it. But hey, we said it was 20, right? And there was a functional payment of, was that what, 14, right? That was within the window. Now, right, the remaining 6, right, is going to be outside the window. We don't get the discount. Well, here the gross method, right, well, we teed it up for the full amount to begin with, right? So this is going to be a smiley in the sense that it's just easy. We can use the simple $6,000. The net method, however, right, we were a little ambitious up here. We thought we were getting that discount for the full amount. Well, at least for, hey, $6,000 of it, we didn't get the discount, right? So it's going to be a little bit more work down here. We got to undo that discount. All right, so this is kind of a good analysis showing you these things, right? So we have the perpetual inventory system versus the periodic, right? We said a lot of the times here with the perpetual, right? Anytime it deals with inventory, a transaction, we're going to account for it, right? We're going to hit that inventory account there, right? That's great. With the periodic system, right, essentially what we're going to do is throughout the period, hit up a lot of these temporary accounts. At the end, do a physical count of our ending inventory and then use our cost of goods sold, right? So here we got a temporary account when we buy it. We got a temporary account for the freight in, right? We got a temporary account for the purchase returns, right? All these guys over here, right? We make a sale, that's great. We're going to record the revenue, but we're not going to do the cost of goods sold right then. We're only doing that at the end of the period. And here we are at the end of the period, right? All those temporary accounts we got to undo, right? We get rid of those temporary accounts. We get rid of our beginning account. We send a guy out to the floor to do a physical count of our ending inventory. We can then plug or back into our cost of goods sold. Okay, so sort of continuing here with this, right? We know a sort of physical flow here of the inventory, right? So if you think about it, right, your beginning plus your purchases of your inventory get you your goods available for sale. You back out your cost of goods sold. That gets you your ending inventory. So if we thought about this from like a physical unit point of view, right? Just raw units. Imagine you were like playing with a kindergartner, right? If that kindergartner started with 4 blocks and you gave them 2 more, right? You said to them, how many blocks do you have? Right? Well, that kindergartner has 6 blocks, right? Well, if the kindergartner had 6 and he sold, I don't know, 4 of them, or no, 5 of them, right? He must have kept 1, right? So if you had 6 and you have 1 left, you must have sold 6. Or conversely, if you have 6 and you sell 5, you only have 1 left, right? So that's the idea here with it. Of the 6, right, you say some you kept and some you sold, right? It's you either did that. It's like sort of unit, or it's just binary there. You either kept it or you didn't kept it. You sold it, right? So here, right, we have that goods available for sale of 11, right? We know 4.5 we kept, i.e. that's our ending inventory, and 6.5 we sold, i.e. that's our cost of goods sold. That's great, right? The problem becomes whenever you do the financial statements, right? You can't be like inventory 6 blocks, right? They don't want it in blocks, they want it in dollars, right? So when we looked at our cost for those 11,000, right? We said, hey, that in dollar amount cost us 71.5. The question becomes, right? We know how many units go over, right? 4.5 and 6, but what dollar amounts should we assign to those, right? We basically are taking this 71.5 and we have to allocate between it, right? And one of the things you could do here is this specific ID method, right? So say that our goods available for sale were 6 blocks, right? We know the idea here is some you kept, some you sold, right? So I don't know, maybe we said it was like 5 you kept or 1 you sold. It was one of those variations. I don't know what it was you kept or sold. I think it was actually the reverse. One of the things you could do here is you could specifically ID it and say, look, I know, right, these were the 5 I kept, and I know for sure this one was the one I sold, right? So I can just use those prices to help spread out the cost, right? If we got to put it in dollar amount, I'll just, put the dollars next to those little blocks for what I specifically paid for each one of those. That's great, right? You can do that, right? In a little simple example like this with 6 blocks, or right, if it's something very unique like automobiles or like houses, right, where you can like really trace it. But imagine that you were like selling Bic pens, right? You were selling millions of pens, right? It would be hard, right, if you had 1,000,000 pens, your goods available for sale, and you said, I know I sold 700,000 and I kept 300. That would be pretty hard to specifically ID, right? So in those situations where we have a lot of like raw, homogeneous, similar goods, right, we are going to make an assumption, basically take the stance and say, look, we'll never be able to individually track 700,000 Bic pens that we sold and 300,000 that we kept. So we're just going to make an assumption and look at really the physical flow on these, right? So here were our Bic pens, right? That's what we started with. We bought some more, right? That was kind of our goods available for sale. We're basically going to take a stance that says, look, we know that we sold, I don't know, what do we have there? What, 2, 4, 5? We know that we sold 3 of them, right? We're going to take the stance that it was these 3, right? That's what we sold. That's one way we could do it, which would be FIFO, first in, first out. You could do the reverse, right? LIFO, right? You make an assumption, look, we're going from the newest to the oldest. Those were the three we sold. And whatever you have left over, right, that's your ending inventory on there. And then somewhere in between, right, we have average cost, which basically says, look, we will put a dollar amount on that goods available for sale. We'll look at how many units it gave us, right? And that will tell us on average what each of those units cost. Oh, we sold 700,000. We'll just multiply that times that cost, that average cost. We kept 300,000. We'll multiply that times the average cost, right? So here's, sort of a setup with this. So they're saying, hey, we have our beginning plus our purchases, right? That's going to give us our goods available for sale, right? 71.5. So that's the magic number we're going to be working with, 71.5 in dollars, right? That was 11,000 units, right? That's what we kind of pluck out here, the units and the dollars. We have 71,000 for 11,000 units. Hey, 650. We know that we kept 4,500. We'll multiply that by 650. We know that we sold 6,500. We'll multiply that times 650. Hey, that's how we're going to split the baby here. We'll do step 1, figure out the average cost up here. Step 2, just multiply that times what we kept and what we sold, right? So that's how you would do that average cost in a periodic system, right? You'd wait until the end and you'd kind of then manifest this here. How would you do it in a perpetual system? Well, essentially, you're going to have kind of a lifetime average cost that you need to continually keep tracking, right? So we're going to look at this. We're not going to do the entire thing, but we'll work our way down. It looks overwhelming, but let's kind of work on this, right? So let's always start with a unitary perspective, right? We started here with 4,000. We sold 2, right? So if you started with 4 and you sold 2, you had 2 left, right? Our average cost here is just going to be 550. They tell us it, right? So in this way, right, it's going to be the 2 we have left times 550. Hey, that's 11,000. Simple enough there. The beginning you will see for all of these is easy because it's just they basically give it to you. Where it gets a little bit more difficult, right, are in these kind of secondary transactions. So let's move on to the next line item, right? We have 2, we bought 1,000 more, right? So now we have 3,000 in there, but we got to figure out, the dollar value on this. You can't put it on there like 3,000 blocks, right? So with this, we got to figure out at this point in time, at January 7th, what is our average cost of these 3,000 units, right? So that will be the denominator, right? 3,000, but on the top, we got to put the dollar amount, right? So it will be, the 11,000 here, right? 2,000, or I'm sorry, it is 11, but it's coming from over here, right? The 2,000 at 550, right? That accounts for 2,000. This 6,000 right here accounts for the remaining 1,000, right? So 11 plus 6 divided by 3, 566. Okay, units times 566, there's our dollar amount. We'll move down one more line item. We're at 3,000 units. We now buy 3,000 more, right? So we're now at 6,000 units, but we can't put it on there like 6,000 blocks. We got to put it at a dollar amount, which means we got to find our weighted average at March 22nd, okay? We have 6,000. That goes on the denominator. That's easy, but we got to see what that 6,000 cost us, right? Of the 6,000 here, right? We're going to have, in this case, the 17,000, right, for 3,000 of the 6,000, and then 21,000 for the remaining 3,000, right? So you do the combo of those two divided by 6. We're at 633. You run the numbers. on that. So you can see kind of how you work your way down on this for the perpetual average. And again, what's going on here? We have our units, right? 6,500 that we sold, 4,500 that we kept. We got to put that in dollars, right? 38.5 and 33,000, right? This is going to be under the FIFO method. So here we're looking at FIFO periodic, right? And in this way, right, essentially what you do is we have, what is it, 11,000, right, units. So say that we had 3, 4, 5, 6. I'm just going to put 6 there, right? So here's our beginning, right? We made some purchases, right? We're doing all this stuff. This is just like theoretical up here. Whenever we have FIFO, right, essentially what we do here is that means first in is first out. In other words, we're going to go to our oldest stuff and get that off the books first, right? So our oldest stuff is our beginning stuff, right? That's like season 1, right? If you watch Game of Thrones, what's the oldest season? Well, season 1, right? So we go from left to right, right? That's going to represent our cost of goods sold. And whatever is left over will be our ending inventory, right? So that's the idea here with FIFO, right? We're starting from up here, our oldest, we're working our way down. That's how we satisfy the 6,500, put a dollar amount on it. There we go. Whatever the leftovers are, right? That's going to be our ending inventory, right? One of the things you could do, right? I mean, you could calculate both of them, but if you know, right, that it's 11,000 total and you get 6,500, you could plug 4,500. If you know in dollar amount it's 71.5 total and you calculate 38.5, then you could plug the 33. So that was FIFO periodic. How do we do FIFO perpetual? Right? So we got to keep in mind here that it's still that sort of same framework that we're going from oldest to newest, right? But we're going to have to track this live time, right? So let's look at this. We'll break it out one by one line item here. So we start with 4, right? That's great. And they tell us there it's 550 per unit, 22,000. That's great. Then what happens is, right? So we start with 4, we sell 2, right? So you start with 4, you sell 2, you have 2 left in that way. Now, when we look at the 2 we sold, right, we're going to start with the oldest stuff up here. And this is simple, right? We only have 1. Remember I said it's always easy in the beginning on these first ones, right? So we can draw from up there. We had 4, we sold 2 from there. We kept 2 at 550. We're looking at 11,000. All right. Let's move on from this. Units first. We're at 2. We then buy 1,000, right? So that means we're now at 3 total, each having their own specific price, right? We just track it independently there. Okay, we're at 3. We buy 3 more, right? So now we're at 6, right? 3 plus 3 is 6, and we track out those individual prices. Now comes, right, sort of the first, interesting sale where we have to look at and apply that FIFO mechanism. We sell 1,500, right? The idea with this is we got to start with the oldest stuff first, right? These sort of things from up here, right? So we're checking off from up here first. So if there's 2,000 and we sell 1,500, right, we're drawing from this pile, the 550 pile, right? That'll give us our cost of goods sold. If there were 2,000 to begin with, we sold 1,500, then there must be 500 that are left, right? We're drawing from the oldest pile, right? You could see if there, is another sale down here, you keep drawing from the oldest pile to the newest pile. All right, how about LIFO? last in, first out. So here, right, if we have sort of what we started with plus what we bought, all of that represents our goods available for sale. We take the approach that we're drawing from to determine our cost of goods sold, our newest stuff first, right? So again, from a unit perspective, we have 11 to account for. This is going to be in a periodic system. So you should have seen this before in your accounting courses. We're going to say, okay, we know we kept 4.5. We know we sold 6.5. Here, we're working from when we're determining our cost of goods sold over here, right? We're working from the bottom up, right? The newest stuff, right? The newest stuff here is on October 15th. Whatever is left over, right? That's our ending inventory. Okay. How do you do LIFO perpetual? Right? Well, we know that you have to kind of keep a live time. Every time we have a transaction, we have to update for it. So let's analyze this. We said it starts out easy, right? We start with 4,000 at 550. We sell 2, right? We can draw right from that pile. Up there, we're going to have 2 left at 550, all the same cost, right? So we're at 4. We sell 2, right? Our balance is 2. All right, we're at 2. We buy 1,000 more, right? So now we're at 3, right? We have the kind of specific prices for that. Okay, we're at 3. We buy 3,000 more, right? So 3 plus 3, we're at 6, right? Where we break out for each of the specific prices. Now, right, we're at 6. We sell 1.5. Right, so you can see, right, what our leftovers are going to be there, right? It's going to be what, 4.5. The question here becomes, right, which ones did we sell, right? Well, remember with LIFO, right, we're going from our newest to our oldest, right? So at this point in time on April 15th, our newest stuff, right, was from that pile right there, the $7 pile. So we're going to draw from here, right, and basically say, hey, this pile, 1,500 of it we sold, 1,500 of it we kept. We'll use the cost number from that to tell us what's going on there. All right. So you can see, right, we have the 3 methods, right? You can see that, yeah, the goods available for sale, you spread it out different ways between them. That's great, but why do we care about this, right? How do you know which one to pick, or like what's from like a theory point of view, how does this all work, right? So here's the setup of it, right? During rising costs, right? So here's our beginning inventory, right? We make some more purchases, right? That's our goods available for sale. Say that during that time frame, right, prices keep going up, right? Each one of these new purchases are more expensive. That's what happened in this case, right? If you were to look, at this, right, it's going from 550 to 7 to 750, right? The prices are going up. In those situations during rising costs, right, FIFO is going to produce a lower cost of goods sold, right? If you look at those 3, that's the smallest, and therefore a higher ending inventory, right? It's the biggest, right? So, that's the theory with it. And it makes sense if you think about it, right? Because it's drawing, right, for cost of goods sold from the cheapest stuff, right? The old stuff that was low cost, so that's going to be kind of a baby cost of goods sold there. So that's during rising costs. If it's during declining costs, right, say it was the reverse, it's never really declining costs, right, because prices always seem to go up, right? Well, then it will be the reverse outcome for FIFO, right? So FIFO will be fixed there. Over here, right, it's lower cost of goods sold and higher ending inventory. But when it's declining cost, it's the reverse. Higher cost of goods sold and lower ending inventory. So with that, I'm going to pause the lecture here just because we're getting to 40 minutes. I'll record a second video for the last 30 slides.